Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Dana Lyons, and we're going to get his take on the market moves after the Fed meeting and where he continues to see opportunity in these markets. As well, we have the S&P touching all-time highs. Dana even brought up we have the equal weight S&P also touching some all-time highs. Very interesting moves that we're seeing in markets. And on my screen today, boy, oh boy, the only thing that I see in the red is the VIX and TLT, the bonds. Everything else green, and green very strongly. Dana is fund manager and editor of the Lyons Share Pro website, which I will link to in the show notes. Dana, look, this is all coming on the back of the Fed meeting, and now the moves today very strong to the upside, but hey, these markets have been trending up for about 2 weeks now after that quick pullback to start this month. Dana, is the party on for markets here?
Yeah, it's a good question. As you know, we've discussed, we take all of our inputs, our investment inputs from market data itself, not necessarily the Fed or economic news or, the tea leaves, anything like that. We're going to take our directives from market data itself. And in general, our models, our quantitative models have been positive even throughout the third quarter, even through that tech-led correction that started in July and has continued into the first half of September. That's because most of our data, most of the input pertains to the broad measures of the broad market, the overall market in general, market breadth, internals, things like that, participation in the market. And in general, it's been solid, it's been stable, hasn't necessarily been hitting new highs throughout the quarter, but has really been resilient. The broad market's been resilient, which is indicative of kind of working off still some of that rally you saw in the first half of the year, and pretty much storing fuel or getting ready for that next leg higher in the broad market. So we do think that's coming. I think we're setting the stage for that. As you mentioned, we do have some broad measures breaking out to new all-time highs, the equal weight S&P, the NYSE composites at all-time highs, the advanced decline lines at all-time highs. So I think the stage is set for another considerable up leg in the bull market. I'm not sure that the Fed meeting is a catalyst to gap higher and just run away with it yet. We do have some troubling seasonality right now. Got an upcoming election. There should be some surprises along the way. But in general, I don't have that much outside of seasonality to really complain about. We do have, again, some of the tech and mega caps have been struggling. They do have some work to do to get through some resistance. We do have some hedges still left on in that space. But for the most part, given the resilience in our model in the broad market, we have taken off most of our hedges here.
Well, Dana, let's also talk about some of the changing dynamics under the surface, because there has been some money rotation out of tech, especially the mega cap tech, with NVIDIA rolling over and some of the other Magnificent Seven. But there's other sectors that are doing great, like utilities. If you look at financials, if you look at healthcare, insurance, if you look at consumer staples, is there a rotation more into some of the value sectors, or is this just a move based on interest rate sensitive sectors?
I don't think it's just an interest rate inspired move. I think there has been a rotation coming into the defensive names for some time, and you've seen that in the performance over the last quarter and a half or so. So we've seen a nice move in utilities, healthcare, staples, the REITs, like you mentioned, some of the value areas, and those have been the places to be really over the last quarter or so, even as tech has taken a breather or potentially topped out in some of those areas. So again, and we've talked about this in the past, that can be at times indicative of a late cycle type of a move, which it very well might be, but it can continue for a while as long as the broad market holds up well. And like I mentioned, broad market in many measures is hitting new highs here. So I think that those defensive names can continue to lead. I would caution that they're a bit extended right now. I would not chase them here. Wait for pullbacks to add to those areas, because they are getting a little bit of traction here. Once everyone starts noticing, that's typically when you see a rotation out and into other areas. But you did mention a couple other sectors like industrials and financials, even materials coming to life as well. So there's no shortage of sectors, market segments that are well positioned for further upside. I don't think you need to chase the defensive names that are already run, wait for pullbacks, better entry points. There are areas that are not quite as extended that you can add to right here if you're looking to allocate some money. And so that's where I would go right here. But again, there's some suspect seasonality here. Might get an opportunity for a better entry point in some of these, but I would certainly maintain a healthy allocation to equities here as the broad signals really remain solid.
Dana, let's give the Bears a little bit of airtime here because, look, you're always going to hear the bearish arguments. We heard the bearish arguments last year that the market was too consolidated just in the Magnificent Seven. That was pulling everything higher. Now we're hearing that the Fed is cutting rates because they see economic weakness on the horizon. We should be potentially getting worried of some market pullback here. What is the bearish case in your eyes? Anything on the horizon that you have at least that you're at least keeping a little bit of an eye on?
Yeah, for us, the outside of the very near term, which would be seasonality led hesitation, the bear case, and again, we're fully on board with this, but the bear case is really longer term. Okay, it's really what we call background indicators, the very long term conditions in the market, whether you want to call it some of the over heavily concentrated or narrow leadership that we saw, heavy concentration, some of the weighted averages. Whether you look at valuation, you look at the amount of investor allocation to stocks, all these things are pretty much at all-time highs again. And generally, longer term returns, 20-year returns are extremely low once we hit these types of conditions. So we are fully on board with that negative or bearish longer term view on things. And obviously, economically, these things don't feed into our models, but there are a lot of troubling signs economically. But again, those are longer term issues and not really timing mechanisms. So they can persist for a while. You can have, a bona fide bubble or melt up even in the midst of those conditions. I'm not saying we will, but it's possible. My point is that you have to have some sort of a timing mechanism fed by direct market data itself so you know when to really pull in your horns or really get defensive or really try to take advantage of those negative long-term factors. But they are extremely troubling and will be, that risk will eventually manifest itself, but it's really more of a sign of the amount of potential risk as opposed to really, a timing mechanism, like I said.
Well, Dana, just to that point, thinking about the longer range indicators in your models, we had talked a couple of years ago when we were seeing that weakness in 2022 that most of the models, after seeing before that a dozen-year run up to the highest levels and the longest bull market we've had really in decades, possibly ever, that it would be natural for a corrective move and a bear market to last not maybe the same amount of time, but a longer period of time than just 1 year. Did 2022, was that the correction that really washed out all that froth? Or on a longer range picture, is the market still at risk of a longer contractionary period than maybe people are thinking about this week post-Fed?
Longer. That would be considered like a cyclical bear market, which generally, maybe you have like a 4-year cycle, which we would call cyclical. Secular is more on the order of almost decades, between a decade or two. And generally, like we've seen those conditions, like you mentioned, got extremely elevated in 2022. We saw that bear market or correction and alleviated some of those excesses that existed. But if you're looking at a longer term secular basis, a lot of those measures are back up where they were or even exceeding them or at least approaching those levels again. And from a secular perspective, it's always been the case with the one asterisk, which I'll touch on. It's always been the case over the last centuries of market action where when you go to an extreme to one end, in this case, bullish excesses, the market always goes to an opposite extreme before that next legitimate secular bull market begins again. Now, the asterisk is really the financial crisis. After we topped out in 2000, there should have been more corrective action. We corrected basically down to the mean in a lot of those background indicators, valuation, investment levels, things like that. Really should have corrected more. I think that all the stimulus kind of prevented that natural correction from happening, and all that stimulus kind of still in the market. A lot of that has to be worked off in addition to what is, naturally occurring bullish excesses. So at some point, that all has to be worked out before I would be confident saying, okay, legit secular bull market can start now. A good example of that would be Japan, topped out in 1990, went through several decades before really putting in conditions for a legitimate new long-term bull market, which I think it's in. It might consolidate here for a while as it tests those 1990 highs again. But I think that's much more, Japan would be much more in position for a continuation of a legit long-term secular bull market than the U.S. We're maybe susceptible to a type of a last leg melt up type of a move, but I don't think 2022, for example, really reset the bar there in terms of those background indicators. I think there's a lot more corrective action that will eventually need to be done.
Okay. Well, I'm sure you'll keep us up to speed on when your models turn more negative, but since they're positive right now, can you explain to us your thoughts on portfolio management? When you do see all of these opportunities, sometimes investors fall in love with certain sectors and they're all into a certain sector. Right now, there's a lot of sectors that you could fall in love with and ride the wave higher. How do you go about diversifying so that you still take advantage of those up moves, but you're not just so focused on one area? Or do you focus on one area?
That's a good question. When it comes to investment selection, what we are investing in, we take a relative strength approach. So we want to be concentrated in those areas that are performing the best. Now, sometimes, like in the instance of the Mag 7, there wasn't that much that was working. So we'll be highly concentrated in like a few areas. That's fine with us. We're not into diversification for the sake of diversifying. If it means that some areas that are not working are going to dilute those areas that are working. So we want to be invested in areas that are performing the best. Now, when there are a lot of potential targets like there are now, we are more than happy to diversify. So right now, for example, we're in a lot of those sectors that I mentioned before, whether it's the defensive names, whether it's industrials, materials, some of the financials, insurance and brokers, a lot of the broad measures, some of the small mid-cap stuff, equal weight stuff, the value, some of the pure value indices that we've talked about that really look time to break out and lead another risk on move higher. So the best case scenario is a scenario like this where our models are bullish and there are plenty of areas throughout the market that are working that we can diversify. So one advantage of that is you look at those defensive names, like I mentioned, we do have a very healthy allocation to those names, utilities and staples and healthcare and things like that. But they're extended right now. If that was the only thing working, it would be hard for us to really pour a lot more money into that because I think they might be in need of some consolidation. But there are other areas that are also working that aren't extended right now that would be a better target of new entries or new money right now, even as we hold. It's not that we're going to sell those defensive names, but we can add new monies to areas that are not as extended. So that's the advantage of having a lot of areas throughout the market that are working at the same time.
Absolutely. Dana Lyons, fund manager and editor of the Lions Share Pro website. Dana, I always find it so valuable to hear what your models are telling you about these markets, more on that short-term basis, filtering out all the noise that you can have by really browsing the web and reading all kinds of market commentators. You're playing, it sounds like right now, a wide range of sectors to the benefit of higher prices. We'll follow up with you in a couple of weeks. Dana, thank you very much for your time today.
All right, thanks.